So, good evening, everyone. So, please come back. Please come back. Let's start our new chapter. Please come back. Vanakkam Shakti. All right. So listen. Shh. Keep quiet and listen. Let's start a new chapter. And what is that chapter? Capital gain. So somebody was asking, when will I start capital gains? So yes, now I'm about to start capital gains. So listen. So you tell me, under capital gains, when will a transaction be taxable under capital gains? For attracting taxation under capital gains, there are certain conditions that require to be satisfied. First of all, there should be a capital asset. Plus, there should be transfer. If you are transferring a capital asset, then the capital gain or losses, whatever you are incurring, shall be taxable normally in the year of transfer. Say for example, whenever you are selling a capital asset, you have to compute the capital gain in the year of sale. Are you with me? Are you with me? So whenever you are computing capital gain, you have to compute the capital gains in the year of sale. Now you tell me, how many types of capital assets you have or we have? How many types of capital assets we have? Two types of capital assets we have. Which are the two types of capital assets? We have long-term capital asset. That is called as where period of holding more than 12 months. We will call an asset as long-term capital asset. What is period of holding? That means the period between date of purchase and date of sale is said to be period of holding. If period of holding of a particular asset is more than 12 months, then, sorry, not 12, I've said 12, right? Sorry, 36 months. That is a general theory. For certain assets, it is 12. For certain assets, it is 12. Like listed share, it is 12 months. But most probably, 36 is the general theory, okay? More than 36 months, it will be long-term capital asset. And if the period of holding is less than or equal to 36 months, it shall be short-term capital assets. Are you with me? Are you with me? But for certain assets, when we discuss capital gains, for certain assets, the period of holding criteria is 12 months. For certain other assets, the period of holding criteria is 24 months. Let's take the example of 12 months assets, important assets that comes under the 12 months category, that is listed shares. Whenever you are computing the capital gain of a listed share, then the period of holding will become long-term capital gain. Sorry, the capital asset or the gain will become long-term capital gain if period of holding is more than 12 months. It's not 36, it is 12 for listed share. Then you can say UTI units. It is whether listed or unlisted. Listed or unlisted, the period of holding always have to be 12 months. And for certain assets, it is 24 months. Which all are the assets comes under 24 months category? Unlisted shares and immovable properties. Like land, building, etc. When you are transferring, the period of holding criteria have to be 24 months. Are you all with me? Are you all with me? So these are actually the basics. So period of holding shall be 24 months for unlisted share, immovable property. Then period of holding have to be 12 months for listed share or UTI units. And can you give me an example for an asset where period of holding criteria is 36 months? Can you give me an example where period of holding criteria is 36 months? Immovable property means land or building. Okay, so land and building will not come. No, not land and building. That is immovable property. Gold, jewelry, archaeological collections, paintings, drawings, etc. Other assets will come under 36 months category. Are you with me? Are you with me? So other assets will come under 36 months criteria. So first of all, now the next thing that you should know, how do you compute capital gain? Say how to compute long-term capital gain and how to compute short-term capital gain. Tell me, what is the methodology for computing long and short capital gain? First of all, you require full value consideration. Full value consideration. That is the gross transfer value. From that, you can deduct direct expenses. You can deduct what? Direct expenses like brokerage, commission, etc. Then you will get what? Net sale consideration. From the net sale consideration, you have to deduct what? Cost of acquisition. That is indexed cost of acquisition as well as indexed cost of improvement. You have to deduct what? Indexed cost of acquisition and indexed cost of improvement. You will get long-term capital gain. What is indexed cost of acquisition? That is this budget. Okay, think about the things that you have to study. You have to complete inter. Then we will think about the budgetary amendments. Okay. Now, listen. Indexed cost of acquisition. What do you mean by indexed cost of acquisition? Say for example, I purchased a property, say in 2001. I purchased a property in 2001 for 1 lakh. 1-2 period, I purchased a property for what value? 1 lakh. Are you all with me? And I'm selling that particular property. For 80 lakhs right now. I'm selling that particular property for what value? 80 lakhs right now. You tell me, when you compute the capital gain, your full value consideration will be 80 lakh. You cannot take cost of acquisition at 1 lakh. Why? The value of 1 lakh in 2001-2 is very high compared to the value in 2023-24 due to the inflation factor. Are you with me? So you have to take that 1 lakh and you have to inflate the value in accordance with the inflation indexes notified by the central government. Are you with me? Are you with me? You have to take that 1 lakh rupees and you have to inflate the value in accordance with the inflation indexes notified by the central government. And what are the inflation indexes? For that, there is a table called as index table. It is given in your book, okay? This is called as index table and this will be there in your examination. Either the entire table or the required index numbers will be provided in examination. So you don't have to by heart the index numbers. You tell me, what is the index number for the year 2001-2002? What is the index number for 2001-2002? 100. What is the index number for 2023-24, year of sale? 348. So I've sold that particular asset in 2023-24. So it is 348. Now how do you inflate that 1 lakh? You take that 1 lakh, multiply it by the index number in the year of transfer, divided by the index number in the year of purchase. Now, can you tell me how much will be your index cost of acquisition? 3,48,000 will be your index cost of acquisition. You have to deduct the 3,48,000 from 80 lakh and you will get the long-term capital gain. Can you tell me how much is the long-term capital gain? 76,52,000. This is how you have to compute the long-term capital gain. And if there is improvement expenditure, you can deduct that also. You can index that also. What is improvement? Cost of acquisition means purchase price. What is improvement? Any additional expenditure that increases the value of asset. Example, a land, constructing a fencing will be an improvement expenditure. Say for a building, constructing another floor will be an improvement expenditure. Are you with me? So for a jewelry, you putting a stone, a valuable stone in that particular jewelry will be an improvement expenditure. Exactly. Putting a diamond on a gold ring will be an improvement expenditure. So indexation is applied on both the cost of acquisition as well as on the cost of improvement. You can apply the indexation both on the cost of acquisition as well as the cost of improvement. Are you all with me? Are you all with me? Now friends, now there is another interesting thing. These are the basics, okay? We'll finish up the basics, then we'll move on to the advanced topics under capital gain, okay? So there is one more thing. Index number is actually starting from which year? 2001, 2002 only. Index numbers are getting started from 2001, 2002 only. You tell me, what if you are purchasing an asset before 1st April 2001? Let's see. If you are purchasing an asset before 1st April 2001, what to do? That's what we are about to discuss. Are you all with me? So these are actually basics. That's why I'm keep on jumping from one page to another. Okay. Let's complete the basics. Then you will get an overall idea when I say the other provision. Are you with me? The revision book has been prepared on the basis of section order. Okay. Revision book actually based on our summary handbook. This summary handbook is actually prepared on the section order. So here also I follow the section numbers, section orders. That's why one thing is in one page and other thing is other page. But when you study this, you should understand the basics. Are you with me? Once I'll finish the basics, then we will follow the revision books order. Okay. So if you are purchasing an asset before 1st April 2001, then what to do? Let's see. Let's create an example. Let me create an example. Listen. I purchased an asset in 1990-91 period. 1990-91 period for say 1 lakh. This is the purchase cost. Then I sold this asset in 2023-24 say for 80 lakhs. Then as you all know, we don't have a number index number for 1991. So what to do? Department say you find out the fair market value of the asset as on 1st April 2001. You find out what? The market value of that particular asset as on 1st April 2001. Say the market value is 10 lakh. Say the market value is how much? 10 lakh. Then what to do? While computing the capital gain, your full value consideration will be 80 lakh. While taking cost of acquisition, your original cost is 1 lakh. But department say either you take your original cost or you take the fair market value as on 1st April 2001, whichever is higher. Actually, Act says whichever is beneficial. Which is beneficial? Higher will be beneficial because it's your cost. Are you with me? So which one you will take in this case? 10 lakh. Then we can take 10 lakh and we can apply the index number, indexation from 2001 to 2023-24. Are you with me? That means 10 lakh into 348 divided by 100. It will be around 34 lakh 80,000 will be the cost of acquisition. Are you all here? You apply the fair market value or you take the fair market value as on 1st April 2001 as the cost of acquisition if you are actually purchasing an asset before 1st April 2001. Then you index it from 2001, 2002 till your year of transfer. Is that point clear? Is that point clear? But there is another thing. Say for example, for this asset, you are incurring an improvement expenditure. Improvement expenditure before 1st April 2001. You are incurring an improvement expenditure before 1st April 2001. You have to ignore it. Whether you are going with the original cost of acquisition or whether you are going with the fair market value as on 1st April 2001, all the improvement cost incurred in relation to an asset before 1st April 2001 have to be ignored while computing the capital gain. Are you with me? Are you with me? Again, that comes under the improvement. Okay. So cost of improvement, you can see cost of improvement incurred before 1st April 2001 always have to be ignored. Don't take any cost of improvement that is incurred before 1st April 2001. Now you tell me, can you take a cost of improvement which is incurred on or after 1st April 2001? Yes, that you can take. Before 1st April 2001, if you are incurring an improvement expenditure, you are not supposed to claim that as a deduction, irrespective of the fact that whether you are sticking on with the original cost of acquisition or whether you are sticking on with the FMV. Is that clear? Is that clear? Yes, superb. So this is how you compute the capital gain. Now there is another problem. Not problem, there is another thing here. Now imagine, yeah, that's what I'm saying. Okay, imagine, say it is a land or a building. Imagine it is a land or a building. Land or a building. Its original cost is how much? How much is the original cost in 1990, 91? What is the original cost incurred by me? 1 lakh. Then I can take the fair market value as on 1st April 2001 as the cost of acquisition. Yes or no? But department say one thing. If stamp duty value as on 1st April 2001, if it is available, then the fair market value shall not exceed stamp duty value as on 1st April 2001. What is stamp duty value? What is stamp duty value? A value maintained by the Stamp Valuation Authority to levy stamp duty charges at the time of purchase. Whenever you are purchasing a property, you have to pay the stamp duty charges. The value maintained by the Stamp Valuation Authority for what? For collecting the stamp duty charges is said to be what? Stamp duty value. Because on 1st April 2001, this digitalization was not happening. So all the lands SDV is not available in India. So that's why they are using a word if available. That means if available in the question. Are you with me? For us, it is available in the question. So the point is, I'll create an example. You should tell me how to take the cost of acquisition. Say the original cost, 1 lakh. In 1991. FMV as on 1st April 2001, say 10 lakh. How much is FMV? 10 lakh. SDV as on 1st April 2001, say 12 lakh. Then you tell me, how do you take the cost of acquisition? Either 10 lakh or 1 lakh, whichever is higher. Normally it is fair market value or original cost, whichever is higher. Are you with me? Say this SDV instead of 12, say it is 9 lakh. This SDV instead of 12, it is 9 lakh. Then what department say? The fair market value as on 1st April 2001 shall never go beyond the SDV as on that date if it is available. So in this case, even though fair market value is 10, you can only take up to 9. 9 or 1, whichever is higher. Is that point clear? So repeat that again. The stamp duty value of a land, we are talking about only land and building. For other assets, stamp duty value is not available. Stamp duty value is available only for land and building. You have to pay the stamp duty charges only for purchasing land and building. Do you have to pay stamp duty charges for purchasing a gold ring? Do you have to pay? Which is a famous jeweler in Chennai? Come again? Kalyan Jewelers, I think it's Kerala Wala Jewelry, right? GRD. GRT. Okay. Is that the legend Saravanan? No. That is Saravana stores, the supermarket, right? Everything you will get. Yeah, he is actually a famous guy right now, right? Acted in the movie. What was the movie name? Oh, that movie's name is Legend. Okay. Yeah. So that movie's name itself is Legend. I saw some part of that movie. Oh, what an actor. He's a fantastic actor. Okay. Yeah. So, there is a funny thing. See, the driver Anna who normally, first time when I reached Chennai for this session, I think last week only I'm here because of the regular classes, okay. I was here and driver Anna was picking me up from the airport and I saw this Saravana Stores board. And then only I thought of this guy, that Legend. I simply asked the driver Anna, how is Legend here? Is he a fantastic guy or a comedy piece? He said straight away, comedy piece, sir. He was not even thinking. Answer was ready. Spontaneously he said, the comedy pieces are. So anyways, I think, but he does the marketing in a brilliant way. Okay, he markets himself in a brilliant way. Even though it's a negative marketing, you guys are trolling him. That's actually marketing for him. Okay, now wherever he go, people recognize him. Okay, and one more thing is, sir, he haven't done anything wrong. He haven't done anything wrong. He only acted in a movie. That is the worst thing. Jokes apart. So coming back to the point, friends, listen. See, black goat in the group. What is that? Black sheep. That Rajini movie, Black Sheep. Okay. So, yeah. Where were we? All the black sheeps and white sheeps, listen. It is SDV. You cannot, your FMV shall not go beyond SDV. This is in the case of land or building. Are you all with me? This is not applicable for jewelry and all. That's why I asked about a jeweler, okay? And we actually went somewhere else. So coming back to the point, this is how you have to compute the cost of acquisition and cost of improvement as well as indexation. I'll give you a basic question for making it concrete, okay? So, it's just a basic question. You can quickly finish this off. You can quickly finish this off. Where is it? Yeah. Can you solve question number 7? Very easy question. Quickly go through this and give me the answer, okay? This is actually basics. So let me make sure that you understood the basics in a very well manner. Ready with the answer? How many of you have an answer? Raise your hands. Okay. From online also I'm getting different answers. Okay. Not enough. Everybody should give me the answer, okay? I can give you 2 more minutes. Please complete it. Complete it ASAP. All right. So let's solve the answer together, friends. So Mr. C purchases a house property for 1,06,000 on May 15th. Shh, keep quiet. May 15, 1975. The following expenses are incurred by him for making addition or alteration to the house property. So incurred certain expenses. Cost of construction of first floor is there. Cost of construction of second floor is there. Reconstruction of the property for 13-14 is there. Fair market value as on 1st April 2001 is there. Stamp duty value as on 1st April 2001 is there. House property sold by Mr. C for 68 lakh. Expenses incurred on transfer 50,000. Compute the capital gain for assessment year 24-25. You tell me where to start. Obviously, you start from the full value of consideration first. How much is the full value of consideration? 68 lakh. And how about direct expenses on transfer? 50,000. And how about the net sale consideration? 67 lakh, 50,000. How about the cost of acquisition? There is a problem. What is the problem? Original cost is in 1975, that is 1,06,000. So you can take either that original cost 1,06,000 or fair market value as on 1st April 2001. But that fair market value shall not go beyond stamp duty value if it is available. Stamp duty value is 875 and your fair market value is 8,50,000. You tell me which should be taken? 8,50,000 only, because fair market value is less only compared to the stamp duty value. So you can take that FMV itself. Now you tell me whichever is higher. Which is higher? 8,50,000. So you can take 8,50,000 as the cost of acquisition. And what is the index number in the year of transfer? 348. What is the index number in the 2001, 2002? 100. Can you tell me with the index cost of acquisition? 29 lakh, 58,000, round figure. Okay. How about cost of improvement? Let's talk about cost of improvement. Cost of improvement incurred before 1st April 2001, you have to ignore. So cost of construction of first floor is in 82, 83. Ignore. Cost of construction of second floor is in 2003, 2004. That you can take. That is 7,35,000. So cost of improvement 7,35,000 is there. And what is the index number in the year of transfer? 348. What is the index number in the year of acquisition? Acquisition not improvement. 2003-4, that is 109. So you can take that 109. And can you tell me how much is the index cost of improvement? 23. 606. There is one more cost of improvement. What is that? They have reconstructed the property in 13-14 for 5,15,000. You can definitely claim that. So 5,15,000 into 348. What is the index number in 12-13? Oh, 5,50,000. Okay. 5,50,000. So what is the index number for 12-13? 220. Now can you help me with the index cost of improvement? 8 lakh? 70,000. 70,000 round figure. Okay. So you deduct these two, these three and tell me how much is the taxable LTCG? 5 lakh? 75,000? 394 should be the taxable long-term capital gain. Is that clear? This is nothing. This is just a basic question. They will never ask this question in exam. Okay. If they ask this question in exam, these kinds of questions in exam, our pass percentage will be around 99.99%. Okay. So they will never ask. I've given this question to make sure that you understood the concept. Now, you have to compute this capital gain in which year, friends? In which PY? 23-24. In the PY in which transfer happened. Are you all with me? Now, listen. Where were we? Yeah, click a picture or whatever. If you don't have the answer, just click a picture or something if you want. Already you got the answer maybe. Yes. Online also. Should you consider expenses? I think you understood. Yes, expenses, yes. Sir, do one sum where vacant land on building or building with land, this type of scenario. What's the difference with if it is a vacant land or land with the building? Similarly, you have to take the cost. Okay. There is no difference whether it is a vacant land or something. The treatment is same. Yeah. So listen, friends. Listen. We have we have completed the basics. Now let's move on in a chronological manner. So there are certain specialities in capital gain. We are about to discuss the special cases in capital gains. So we will start from now we will follow the order. Now you will understand if I follow the order. So now you will understand why I started from capital gain, basics, then I jumped to cost of acquisition, then I jumped to cost of improvement. Now you will understand. Okay, listen. Normally, as I've told you, capital gain will be taxable in the year of transfer. Whenever you transfer a capital asset, in that year of transfer, you have to compute the capital gain and pay the taxes. Are you all with me? Are you all with me? But for that theory, there are certain exceptions. For that theory, there are certain exceptions. One of the exceptions is section 45(1)(a). And let's understand what exactly is this 45(1)(a) is all about. Vacant land is there. On that, we construct a building. After we sold that, in this case, how to calculate? Vacant land will be the cost of acquisition. The construction cost will be the cost of improvement. Sales value will be the full value consideration. You compute accordingly. Yes. Now, where were we? 45(1)(a). That is receipts from insurance parties. Say, listen, very simple. You have a capital asset. What? You have a capital asset. That capital asset got destroyed. That capital asset got destroyed either due to flood, typhoon or hurricane. Flood, typhoon or hurricane. You know what is flood. You know what is hurricane. You know what is typhoon. And cyclone, earthquake or other convention of nature like tsunami, volcano eruption, whatever it is. Your asset got destroyed. Or due to riot or civil disturbance or accidental fire or explosion. Explosion happened and your asset got destroyed. Or because of action by enemy. What is action by enemy? Some terrorists came and attacked us and our asset got destroyed. Or action taken in combating the enemy. Our navy or our army actually shoot at the enemy, but ultimately that asset got destroyed. Okay, they had very good aim. So they shooted at the terrorist, but our asset got destroyed. Or the terrorist head, that bullet pierced his head and our asset got destroyed. Let's not, demoralize navy. All right, sorry, army. They correctly shooted, but the bullet pierced his head. Free fire. Then a game, okay. Free fire is a game, right? All right. So, whatever it is, that asset got destroyed ultimately. Yes, war it is. So, in these cases, if there is a destruction of your capital asset, you already had an insurance for that particular capital asset. You already had what? An insurance for that capital asset. Are you with me? If there is a destruction, your insurance company will definitely give you a compensation. Your insurance company will definitely give you a compensation. Then suddenly income tax department will come and say, we want treat. What? Your asset got destroyed and you got compensation. It's a time to celebrate. Let's celebrate the destruction. Okay, you have to pay taxes for that. Why? Because if there is an asset and there is a destruction, that destruction is normally called as extinguishment of assets. It is also regarded as transfer. What is extinguishment? Your right over the asset came to an end due to destruction. And if you have an insurance compensation, if you are getting an insurance compensation, that compensation have to be treated as the full value consideration and you have to compute the capital gain accordingly. Are you with me? Are you with me? So we will read that chart again. If your asset is getting destroyed due to, read along with me, flood, typhoon, hurricane, cyclone, earthquake or other convention of nature, riot, civil disturbance, accidental fire, explosion, because of action by an enemy or action taken in combating the enemy, a person receives any money or other assets under insurance on account of the above, then gains, if any, are taxable in the PY in which such money or other assets was received or is received. You can cross off was is received. Such money or other asset is received. That year only you need to pay the taxes. Even though year of destruction is the year of transfer. So it got destroyed today. You got insurance compensation next year. You have to compute the capital gain next year, not in the year of destruction. But the year of destruction is the year of transfer. Because here transfer is extinguishment. That is the destruction. Are you with me? Are you with me? Now you will find a problem. How do we compute capital gain in such scenario? To solve that problem, I have given a computational format here. Okay, if you check the computational format, you will understand how to compute capital gain over here. Which value should be the full value consideration? You tell me. Either the cash or fair market value of asset received. In 99.99% cases, insurance company will pay you money. Money only. Okay. If they are giving you another asset, then you take the fair market value of asset. If they are giving you money, then the full value consideration have to be the money. What if they are giving both? They are giving an asset plus some money. Then you add it together. Fair market value of the asset received plus cash received. Are you with me? Are you with me? Now you tell me what is the direct expenses. What will be the direct expense? As usual, normal direct expenses you can claim. What about the cost of acquisition? Purchase price of the asset. It got destroyed due to earthquake. That doesn't make any difference in the cost of acquisition. That is the normal cost of purchase only. And in which year? How about indexation? Till the year of destruction. That means I purchased an asset in 2015-16. Are you all listening? It got destroyed today. That means in the year 2024-25. Next year I received what? Compensation. I have to compute capital gain only in the next year, but indexation I will get only till this year. Because indexation, that means year of transfer is the numerator of the indexation. Hope you remember. Numerator, you have to take the index number in the year of transfer. Denominator, you have to take the index number in the year of purchase. Even though you are computing the capital gain later, you will always get indexation only up to the year of destruction, not after that. Is that point clear? Then, how about the taxability in the year of receipt of compensation? How about the tax rate as applicable in the year of receipt of compensation? Is that point clear? Do you want me to give you a small question in relation to this? I'll give you a question because that's actually a fantastic question. Okay. That's actually a fantastic question. Before, oh my God. Nothing happened. It's gone. Okay, no worries. So, I'll give you a question for a better understanding. That question actually is in 2 pages. I'm not showing the index numbers, that you can make use of the revision material. Okay. Use the revision material for the index numbers. I'm not displaying the index numbers. Just go through this question and give me the answer. Okay. Index numbers, make use of your revision material. Okay. See, one thing, when you solve this question, one thing is there. That is a definition of capital asset, okay? Capital asset does not include movable personal effects. Capital asset does not include movable personal effects except jewelry, drawings, paintings, archaeological collections, sculptures, and artwork. Are you all listening? In the definition, section 2, subsection 14, there is a definition for the word capital asset. Capital asset, what department say? Capital asset does not include movable personal effects. For example, I have a car which is used for my personal purpose. That is not capital asset. I have a furniture which is at my home. It is not a capital asset. But if the car is used for the business and capitalized in the books of accounts, then it is capital asset because it is not personal effect. If the furniture, if it is capitalized in the books of accounts and used for office purpose, that will become my capital asset. Are you with me? Are you with me? Yes, now one more thing. Movable personal effect means jewelry, gold also are movable personal effect, but there is an exception. Jewelry, drawings, paintings, archaeological collection, artwork and sculptures, even if it is movable personal effect, that have to be treated as your capital asset. These 6 items. I'll repeat. Jewelry, drawings, paintings, archaeological collections, sculptures and artwork. Yeah, I'm getting different answers. Very good. Yes, what is your doubt, Ragul? Twenty-four 25 index number. 24 25 PY. Your PY is 23 24. So you only require. You don't require that index number. You don't require that index number because you will get indexation only till the year of destruction. Regularly, you don't require index number for 24-25. Okay. You think why? So let's compute it together. Shh. Lucky, shh, keep quiet and listen. Lucky has a house property acquired on 18/8/2009 for 6 lakh. He used the house for his own residential purpose. On 18/8/2012, he incurred a capital expenditure on reconstruction of the house. That is rupees 3 lakh. On 15/5/2018, he bought office goods, inflammable, worth 1 lakh at home to be delivered to a party staying near to his home. So he, on 2018, he bought some inflammable goods to his home to be delivered to some party which is staying nearby his home. At the night of that day, accidental fire took place and damaged the whole house property, furniture worth 5 lakh and business stock. So unfortunately at that day, a fire breakout came and completely destroyed his stock, house and furniture, and his name is Lucky. Maybe his parents might have foreseen that. That's why they called him Lucky. But don't laugh, he's lucky. Why? Because he had an insurance for the building, stock and furniture, and the insurance company given him claim. So insurance claim received on 18/8/2023. It took some time, but he received insurance claim on 18/8/2023. So you tell me, in which year you have to compute the capital gain? 23-24. That is year of receipt of insurance compensation. Are you with me? So we are computing everything in the PY 2023-24. Now, which all are the destroyed assets he have? House property. Second one, furniture. Then stock in trade. Out of this, for house property is a capital asset. House property is a capital asset because it is not a movable personal effect. It is immovable. Your house property, can you move it? Doubt? Today, when you go home, you try pushing it, okay? Go home and try pushing it, okay? House property is a immovable asset, so it is definitely a capital asset. Then furniture at home, it is movable personal effect. So not capital asset. Stock in trade, not capital asset because it is covered under PGBP. Under PGBP only. So we need to compute the capital gain of house property only. The loss or profit that you are getting in relation to furniture is not taxable. The loss or profit that you are getting in relation to stock in trade will be taxable under PGBP. Are you with me? So in relation to house property, can you tell me how much is the full value consideration? How much is the compensation that you have received for house property? You received 1 lakh cash and fair market value of another property of 45. So altogether, how much is the total value? 44 lakh plus 1 lakh, that will be 45 lakh is the total value of consideration that you have received for the house. Are you with me? So it is 45 lakh is the full value consideration. Is there any direct expenses on transfer? They are not mentioning anything, so you don't have any direct expenses on transfer. So the net sale consideration will be same 45 lakhs. How about the cost of acquisition? Do you have a cost of acquisition? Of course. House property, there will be a cost of acquisition. So how much is the cost of acquisition? 6 lakh that in the year 2009. So you can claim the benefit of indexation. But my question is, from which year to which year? You can claim indexation. From which year to which year? From 2009-10 to 2018-19. From where the hell this 18-19 came from? That is the year of destruction. So he took the inflammable goods on 15/5/2018. And that day, night of that day, an accidental fire took place. So that is the year of destruction. That is the 18-19. And what is the index number? In examination question, there will be index number, okay? They will definitely give you index number. Since I want to make this in one page, I skipped that index table, okay? What is the index number for 18-19? 280. What is the index number for 2009-10? 148. So we'll make use of these index numbers and let's index the cost of acquisition. So cost of acquisition is 6, okay. 6 lakhs into, can you help me with the numbers? 280 by 148. So can you help me? How much will be the index cost of acquisition? 11,35,135. How about cost of improvement? He have constructed something over there, right? So he have constructed reconstruction house 3 lakh. That is in 2012. Can you help me? What is the index number in 2012? 200 in 2012, right? 200 into 280. Can you help me? How much is the indexed cost of improvement? 4 lakh? 20,000? Down 20,000. Now how much will be the taxable LTCG? 29,000. 29 lakh? 44,865. Put separators, otherwise when you start your articleship, your principal will scold you left and right. He have given you a figure, you don't know whether it is crores, lakhs or thousand. In a meeting and all, you will start 0, tens, ones, lakh. If you be like that, your principal will definitely kill you, that's for sure. So always put separators. Once you put separators, when you see the figure itself, you will understand whether it is lakh, crore or whatever it is. Are you with me? Good. So this is the long-term capital gain. And in furniture, what is the value of the furniture? Full answer. Yeah, I haven't completed it, Ali. Don't worry. Okay, I'll complete it and I'll show it to you. Definitely, I'll show it to you. Okay. Yes. So, what is the cost of furniture, friends? It worth. Sorry, not that. Delivered to the house. Yeah, it is 5 lakh. The cost of furniture is 5 lakh. And how much you got from the insurance company? 2 lakh. So you have a loss of furniture. How much is that? 3 lakhs. So the cost of furniture is 5 lakh and the compensation, how much? 2 lakh. So how much is the loss? 3 lakh is the loss. What to do with this loss? Ignore. Because it is not a capital asset and you cannot claim that loss anywhere. If it is a profit also, you wouldn't have to pay taxes. But you will never get profit. Why? Because furniture, every year of usage, there will be a loss in the value. For car also it is like that. You use a car, every year the value will go down. That's why movable personal effect are not considered as capital asset, because if it is considered as capital asset, then you guys will come and ask for the loss. Yes or no? Yes or no? See, in capital gain, both the gain and loss will come. Don't consider it as a benefit. It is not at all beneficial. If they are saying all mobile assets as capital asset, then what will happen? The car that you sell, you will claim it as your loss. Department know that. The rarest of the rare case only, you will be able to sell car at profit. If you are doing it in a second-hand sales or something, then that will be your business. Then that profit will be taxable under PGBP. You bought some car, second-hand car, and you sold it for a value which is more than the purchase value. That is very rare. No problem. Don't pay us tax. Because 99.99% cases, it will be loss only. Okay? Yes. Sale of office car? Yes. Office car means capital asset, not personal effect. Okay? Yes. It's a depreciable asset. Section 50 will come into the picture. Hello, today morning only I taught you section 50. Yes or no? This is how you have to understand income tax. Whatever comes in left and right, you should give the answer. You should be able to give an answer. Are you with me? Use the revision note, okay? Use this revision note. This will definitely help you because I've included most of the things in this particular revision note. Are you all here? Yes. So, let's complete the answer. We have stock in trade. What is the cost of stock in trade? What was the cost of stock in trade? 1 lakh. And what is the amount that you got? 80,000. So, how much is the loss? 20,000. So, cost of stock in trade is 1 lakh. And the compensation that you got is 80,000. So, the loss will be 20,000. What to do with this loss? It will be shown under PG/BP. They are not asking for this, okay? But still, I have computed it. That's it. Are you with me? Now, they are asking one more thing. Tax treatment under capital gain. This is what they ask. So, the official answer should be only this much. Okay. Now, not yet over. How shall your answer differ if such compensation is received by assessee on 15/4/2024? What will be the change? Year of taxability will be PY 24/25. The answer is the same. There is no change in the indexation and all. Are you with me? And actually, central government have notified the latest index number for 24/25. It is 363. That is not record for you. Central government have notified the latest index number, that is 363. Okay, that is for 24/25. Your PY will be 23/24. So you don't have to know the 363 index number. Yeah. Can you please again explain how 45 lakhs? 44 lakh plus 1 will be 45 lakhs. Idu paru. 1 lakh is the cash. 44 lakh is the fair market value. 44 plus 1, 45. Got it? My net, don't cry, da. It's okay. He's crying. Compensation given cash, okay. Good. Ali, you got the answer. I mean, you understood. 1 lakh into 280 by 200. What is that? Come again? It is 3 lakh. But the answer is wrong then. Oh, answer is right. It should be 3. Into 280 by 200, it will be 4 lakh 20. Okay. Yeah. Okay, thank you. Yes. All right. So let's move on with the next thing in under capital gains. Okay, there is a problem. 1 second, friends. I've accidentally closed that revision sheet. Sir, won't that loss of furniture be recorded anywhere? No. That's what I'm saying. Okay. You don't have to. Recorded means in your personal record you can write. Not to the income tax department. They don't want that. Should we simply ignore? Yes. Yes, Darshini. That is a personal loss. You are not supposed to show it anywhere. Yeah. So moving on, friends, we were discussing about 45 subsection 1A. Now let's understand what is 45 subsection 2. Can you read the heading 45 subsection 2? Conversion or treatment of capital asset as stock in trade. Or rather, sticking on to the theory, I'll take some problem oriented area. Okay. Since it is late evening, I'll take some problem. I'm not saying that I will leave you right now. Okay. Don't misunderstand me. These are theory, okay. Let it be there. We'll finish up some problem-oriented area so that I can give you some questions in between also. So let these things be here. Let's straight away go to the cost of acquisitions. There are certain interesting things under cost of acquisitions. We'll complete the cost of acquisitions right now. So listen. You should know the treatment of right shares. Okay, shh. Keep quiet and listen. What do you mean by right shares? What do you mean by right shares? we'll say treatment of right shares, okay. Theory is there in your revision handout. Theory is there in your revision handout. Theory is there. What is the page number? You can take the page number 34. Theory is there in page number 34, okay. Now, let it be there. Let me use this particular chart to make you understand what is the treatment of right shares. You tell me what is right shares? What is right shares? Whenever a company is planning for a IPO or FPO, that means initial public offer of a further public offer, or whenever they are planning to issue more shares, the first thing that the company should do is what? Offer that shares to the existing shareholder for a price which is lesser than the market value. Offer that share to an existing shareholder for a price which is lesser than the market value. So we will take an example. Say the market value of a share is 1,000 rupees. Okay, right price is say 600 rupees. What is right price? Existing shareholder is only supposed to pay 600 rupees to acquire that particular share. It is not issued at discount. Discount means less than par value or face value. That is not possible in Companies Act 2013. You cannot issue shares at discount. But you can issue shares at a value less than the market price. Are you with me? So the right price is only 600. This will be normally offered to an existing shareholder through a offer letter. We call it as offer letter. Technically, it is known as right entitlement. You might have studied this in your law. Okay, whether you have studied it or not, I'm not taking any chances. I'm explaining it. Okay, this is actually law. So a company will offer this right share to the existing shareholder by way of issuing a right entitlement, or we can say offer letter. It's nowadays it is given by way of a mail. Okay, it is not a physical letter, it's by way of a mail. Now the existing shareholder have three options when he received that particular offer letter. What are the three options he have? Either accept it. Listen. Say first one, let's complete. Either he is accepting it. He accepted it and he sold that particular share after some time. He accepted that right shares and he sold that right shares after some time. Are you all listening? He accepted it and selling that right shares after some time. What will be his cost of acquisition for that right shares? He accepted that right share. Then he sold that right share after 1 or 2 years. My question is, what will be the cost of acquisition of right shares when he subsequently sell that right shares? It is 600 rupees per share only. Why? Because he received that right share for 600 rupees. Are you with me? So this cost of acquisition on subsequent sale will be only the right price 600 rupees because he paid only 600 rupees. Are you with me? Now, say he rejected it. What is rejected? Not accepted. Then there is no capital gain impact. The company offered a right share and he said, I don't want it. Very simple. He rejected it. So there is no capital gain impact. And there is one more thing that is called as renouncing the right. What is that? Renounce. What are you renouncing right? He took that right entitlement and sold that right entitlement to another person. He took that right entitlement and he sold that right entitlement to another person. Say another person, say AP. What is AP? Another person. Okay. So AP bought that right entitlement for 100 rupees. AP bought that right entitlement for what value? 100 rupees. Right entitlement is also a capital asset. That right that he have is also should be considered as a capital asset. Now you tell me, when he sells that right entitlement, you have to compute the capital gain. When the existing shareholder sells that particular right entitlement, you have to compute what, friends? Capital gain. And you tell me, what is the full value consideration of that right entitlement according to the example? What is the full value consideration of right entitlement according to the example? 100 rupees. Why? Because he sold that right entitlement for 100 rupees. Are you with me? Now the interesting fact is, what is the cost of acquisition of right entitlement? 0, because it is actually you received it for free. You have to pay something for getting right entitlement. No. You have to pay 600 rupees for getting right share, not right entitlement, amma. Okay. Are you all with me? You have to study law also, okay? Then only you will be able to qualify CA Inter. This is actually law. Are you all with me? Sir, please once again. Day. You're testing my patience, huh? See, right entitlement is also a capital asset. So whenever you are selling right entitlement, the sale price have to be treated as a full value consideration. The cost of acquisition of right entitlement will be always 0, because you are getting it. Why? Because you are an existing shareholder. You don't have to pay anything for getting that right entitlement. Are you with me? So the cost of acquisition is 0. And this capital gain will be always short-term capital gain. Why? Because the life of right entitlement will be for maximum 90 days. That right exercise will get expired within 90 days according to the company law. So practically, for selling right entitlement, there won't be any long-term capital gain. Are you with me? This will be always STCG only. Are you with me? Now not yet over. Now this, another person, AP, he purchased right entitlement for what value? AP purchased the right entitlement for what value? 100 rupees. He have to pay another 600 rupees to get one right share. Yes or no? He paid 100 rupees for the right entitlement. Now he is supposed to pay another 600 rupees to the company for acquiring one right share. Now tell me, he got one right share from the company and he is selling that right share. He got one right share from the company and he is selling the right share. What about his cost of acquisition? It is 600 to the company plus 100 for the right entitlement. Altogether it will be 700. Are you with me? 600 he have to pay to the company for getting one right share, and he already paid 100 for acquiring the right entitlement. So altogether for one right share, his cost will be 700. Are you all with me? Yes, is that point clear for you? Yes, sir, also if buys the right entitlement, is it only for this time, or even the company offers right share again, then it goes for the buyer or employee who sold it. I don't understand first of all. This is not only for one time. Whenever this happens, you have to compute it like this, okay? Actually, I didn't get your question, Aditya, so you have to be more elaborate on this. I didn't get what you asked. Now, let's solve a question based on this, okay? So before this, let's complete the theory, okay? The theory part. The theory part is very simple. Since to make you understand this, I have drawn the entire circumstance. So we are talking about cost of acquisitions. Cost of acquisitions. Because this comes under the cost of acquisition, okay? Ascertainment of cost of acquisition. Now, can you read the first one? Right shares acquired by assessee. What will be the cost of acquisition? Cost of acquisition shall be the right price. When the existing shareholder himself accepts the right share and he sells it, the cost of acquisition will be the right price. In the case of a right renouncement, cost of acquisition of right entitlement shall be always 0. That means when the existing shareholder is renouncing the right, the cost of acquisition of that particular right entitlement will be 0. For the renouncee, who is renouncee? In our example, it is the AP. Renouncer means existing shareholder. Renouncee means the person who buys that right entitlement. For him, what will be the cost of acquisition? Right price plus amount paid to acquire the right entitlement. That means 600 plus 100, that will be 700. Is that point clear? Is that point clear? And I'll make you solve a question. I've selected one question here. It is there in your question sheet. Yes. Can you read question number 11 and give me the answer? It's a good question. Okay. Can you read question number 11 in your, it is there in your question sheet that I've shared. Question number 11. Sir, the employee BT, he sells the right entitlement to M. Employee, what to do with employee here? Okay, you're talking about existing shareholder. Then, if the company offers FPO, again 5 years, then will the right offer to go to the employee, not employee, shareholder. Yes, again and again, the company have to offer shares to the existing shareholder first. Okay. Then M who got the entitlement is also an existing shareholder. Okay. On subsequent issue, that M is also an existing shareholder. Yes. To T as well as to M, the company have to offer right shares. When you are renouncing it, you yourself have to find a buyer. Okay. It's not necessary that there is a buyer. Compulsory for the buyer to purchase it. What are you asking? Like, there should be some buyer. How can you compel someone to purchase it? Okay. You cannot compel someone to purchase it. There should be some buyer. Otherwise, you yourself have to keep it, or you can reject it. It's up to you. If you have a buyer, you can renounce it. Otherwise, not. Understood, Aditya? If you have a buyer only, you can renounce it. There is no mandation that you should have a buyer. Okay. Done? Yeah. You have to compute the capital gain of R and Q, whoever it is. Okay. You have to compute the capital gain of everybody. If shareholder sells the entitlement right or the shares or both go together, sir. Say, do one thing, Aditya. You solve this question, you will understand the concept. Okay. First of all, I'm not understanding what you are asking. Okay. So you solve this question, you will understand the concept. Sir, for salary chapter, cost inflation index amendment. Why do you want inflation index for salary? I didn't get you. What are you asking, Z? All right. So, computation mistake, don't worry. Okay. Make sure that you're not doing the same mistake in exam. Okay. Yes. All right, friends. So let's compute it together. Mr. R, listen. Mr. R holds 1,000 shares in Star Minus Limited, unlisted company, acquired in the year 1-2 at a cost of 75,000. He has been offered right shares by the company in the month of August 2023. So, offered right shares in August 2023. Okay. What is the right price? 160 per share. In the ratio of 2 for every 5 share held. So, listen. How many number of shares Mr. R have? How many number of shares Mr. R have? 1,000. So friends, listen. Say you have learned a concept, but in examination you are not getting a grip over the question. Then what to do? You know that you have studied that concept, but you are not getting a grip over the question in examination. Then what to do? Skip the question and read the next question. Huh? What to do? Very simple. Note down the important facts and figures of that particular question. Not everything, okay? Only the important things. So Mr. R is there. How many shares he have? Original shares 1,000. You can say ORGSH, original shares. And which is the year of purchase? 2001-2. Then the company offered him right shares. How many right shares he got? 2 for every 5. That means 1,000 by 5 into 2. That is how much? He got 400 shares. Then what did he did what? 50% rights he retained and renounces the balance 50% for 30 rupees per share. So the right price was 160 rupee per share. Out of this 400, we can divide that into 2. He accepted 200 shares. So for 200 shares at what cost? 160 per share. Are you with me? And he renounced 200 share right entitlement at 30 rupees. Are you with me? Who purchased this particular right entitlement? Mr. Q. She purchased, she or he, whatever it is. He or she purchased that particular right entitlement. It's Mr. Q, okay, not then it is he. Purchased the right entitlement for what value? 30 rupees per share. And he have to go to the company and pay 160 rupees per share for the right shares. This is for the right entitlement and the other for the right shares. Then what happened? All the shares are sold by R for 300 per share in January 24 and Mr. C sold all the shares in December 23 at 280 per share. So both of them sold all the shares. When they are selling, sold all the share. In the case of R, it will be original right share, including right entitlement. Are you with me? So what you need to do in examination, if such a question they are asking, then Mr. R, you have to split how many type of assets he have? Original shares. Then right shares. Then you have right entitlement. You have to split that into 3. And what is the full value consideration of original shares? 300 into 1,000. That will be 3 lakh. How about right shares? How many right shares? 200 right shares he sold into 300 rupees and that will be 60,000. How many right entitlement is sold? 200 into 30 rupees per right entitlement. That will be 6,000. They are not mentioning anything about direct expenses. So I am straight away writing cost of acquisition. What is the cost of acquisition of original share? 75,000. You can index that because it is in the year 2001-2002. So into 348 divided by 100. And can you help me with the index to cost of acquisition? 2,61,000 round figure. How about right share? You cannot claim any indexation. Why? Because right share is a short-term capital asset. Why? Because he received that right share in which year? August 2022, right? Or 2023? See, September 2023, right? He renounced the company. There is actually a small mistake in the question, seems like. They're saying month of August to, it's no mistake. August 2023. And he renounced it in September 2023. Okay, no mistake. It's perfect. So he received only in August 2023 and sold it in that year itself. Are you with me? He sold that year itself. January 2024, he sold that particular shares. So you tell me, it will be a short-term capital asset, and how much is the right price? 160 into 200 shares. And can you help me with the math? 32,000 will be the cost of acquisition. And how about the right entitlement? Nil. How much will be the long-term capital gain in the first case? 39,000 will be the LTCG. How much is the short-term capital gain in second case? 28,000. And how much is the short-term capital gain in the third case? 6,000. Now it's not over. You have to compute the impact of Mr. Q as well. So when it comes to Mr. Q, the full value consideration is 280 per share into 200 shares. How much is that? 56,000. How about the cost of acquisition? 190 per share into 200 shares. That will be 38,000. So can you help me with the short-term capital gain? 18,000 shall be the short-term capital gain, and that is the final answer to the question. Is that clear? Online friends, is that clear? And who was asking lots of doubts? Who was that? Aditya, have you understood? Yes, that's why I told you to solve this question, okay? You will get an idea over this. Now, let's take another concept. We have time. So, you have doubts? Any doubts? Okay. Yeah. Moving on to the next concept. We'll think about bonus shares now. Yeah. We'll think about bonus shares right now. What is bonus? Yeah. Answer yes. This is the full answer. You need the chart, including the chart. Okay. Take a picture for the chart first. Then this is the answer. In examination, this much elaboration is not required for the chart, okay? Whether you draw a chart or you don't draw a chart, you will not get any extra marks. But this should be there. Obviously, then only you will get marks, okay? Yes. So moving on with the next concept, bonus shares. Can you tell me what is bonus shares? What is bonus shares? Shares which is issued? Actually, it is not free, but we can say it is free. It is called as capitalization of profits. You have a lot of profits in the reserves and they are not distributing it as dividend. Instead of they are saying, using the word free. Then what will happen? Thank you so much. You are not receiving dividend, no problem. I'm getting free shares. More than enough. So the company is actually making the shareholders to reinvest that particular surplus to that particular company itself. Are you with me? Now think from a shareholder's perspective. You are in receipt of some bonus shares. And after that, you are selling that bonus shares. What is the cost of acquisition of bonus shares? What is the cost of acquisition of bonus shares? Zero. You don't have to incur a cost. You will get it for free. Are you with me? So what department say? In the case of a bonus shares, the cost of acquisition shall be zero. But there is one unintended benefit that you can take in bonus shares. What is that unintended benefit? Do you remember? Whatever asset you have purchased before 1st April 2001, when you compute the cost of acquisition, either you take the original cost of acquisition or you take the fair market value as on 1st April 2001, whichever is beneficial. Do you remember the theory? In that theory, income tax department is not saying excluding bonus shares. They're only saying any capital asset purchased before 1st April 2001, you can take the fair market value as on 1st April 2001 as the cost of acquisition. Are you with me? It's actually unintended benefit. But department say no problem. It is only applicable for those bonus shares which is issued before 1st April 2001. We don't have to address it right now. So, according to that theory, what you can do is bonus shares allotted before 1st April 2001 also, you can take the cost of acquisition as the fair market value as on 1st April 2001. Are you with me? Are you with me? So you can take the cost of acquisition as the fair market value as on 1st April 2001, provided you received that bonus shares before 1st April 2001. Have you understood what I said? If the bonus shares is issued after 1st April 2001, then what will happen? Then cost of acquisition shall be 0 only. Let's solve a question quickly. This is a mix of the bonus shares thing, okay? So please take question number 10. So fantastic question, Usha. Just go through that question quickly. For 44 AD applicable for retail traders, okay. ADA applicable for notified professionals. AE applicable for goods transporters. So AD is like you take the 8% of your turnover as presumptive profit. If you are a normal trader, all right. And if the receipts are through account pay check or account pay bank draft or ECS or prescribed electronic mode, then instead of 8%, it should be 6%. That is AD. ADA can be claimed only by a notified professional like accounting, medical, legal, interior decorator, like that. For that, what they are saying is your turnover is less than or equal to 50 lakh. You have to show 50% of the turnover as presumptive income. But that can be claimed only for notified professionals. If you are a notified professional, no 44AD. It is under ADA. And if you are a goods transporter, no AD, no ADA, it will be under 44AE. That is based on the tonnage capacity of the vehicle that you have. If it is a heavy vehicle, then 1,000 rupees per ton, per vehicle, per month, or part thereof, based on the ownership. If it is other than heavy, 7,500 rupees per vehicle, per month, or part thereof. This is how you have to compute AD, ADA, and AE. Yes, Nasim. Yes. So let's compute the answer together. How many of you have an answer? All right. Great. So listen. One second. Yeah. So Miss Usha purchases 1,000 equity shares in X Limited, an unlisted company, at a cost of 30 per share, brokerage 1%. So listen, friends, at a cost of 30 per share, in brackets they are writing brokerage 1%. What does that mean? 30% is inclusive of all the cost. Cost means what? For one share, she have expended in total 30. Yes or no? See, I bought one bottle of water. Okay, I bought one bottle of water and my cost is 100. This bottle of water, MRP is only 80. I took an auto. Okay, I took an auto for buying this bottle of water and total cost is 100. That means what? All the associated costs that I've incurred to buy this bottle of water is 100. Something similar to that they have written. Cost of 30 per share means total cost include in that purchase is how much? 30. That includes 1% brokerage. Are you with me? Nothing to do. Simply said, okay. Because in this question, anyways, we are about to take the fair market value as on 1st April 2001. Are you all here? You have some update from the KSA team. So even if I, what do you say, leave you, you are not supposed to go. Like you have to wait here for 5 to 10 minutes. Okay. You have some update from the team. Okay. Yes. So the point is, I'm about to leave you within 10 minutes, but after the classes, you have to wait here only because you have some important announcement coming. I don't know whether it's important or unimportant. Something is coming. Okay. Yes. Listen. Where were we? Cost. Sorry, cost. Keep quiet. Keep quiet. So, 30%. Sorry, 30 rupees in 1996. Shh. She gets 100 bonus shares in August 2000. She again gets, shh, keep quiet. She again gets 1,100 bonus shares by virtue of her holding on February 2007. So how many set of bonus shares she got? 2 set of bonus shares. One on 2000 August and another 2007 February. The fair market value of the shares of X Limited as on 1st April 2001 is given 80 rupees. On 1st January 2024, she transfers all her shares at 200 per share. Okay. So what we can do is, we will take the full value consideration. Before that, how many set of capital assets she have? Original share is there. Then first set of bonus shares there, which is received in August 2000. Then second set of bonus shares there, which is received in February 2009 or 7? 7. These are the assets she have. Now tell me how much is the full value consideration. All the shares are sold at what value? They are saying some value. All the shares are sold at 200 per share. They are saying brokerage 2%. That is not net off. Okay. They are saying all the shares are sold at 200 per share. On 1st January, she transfers all the shares 200. Brokerage is not an income. It's an expense. Are you with me? So 200 is the transfer value. From that you have to net off. It is not due to you have used the bracket. In the cost they are saying cost. Cost means every payout. Here transfer means whatever you get, that is the gross. From that you have to deduct the brokerage 2%. Okay. So what you need to do is, how many shares? Original shares? 1000 original shares. 1000 original shares into what is the value? 200 per share. And how much is the full value consideration? 2 lakh. How many bonus shares? 100 into 200 shares. And what will be the full value consideration? 20,000. How many second set of bonus shares? 1,100 into 200. That will be 2 lakh 20,000. Now direct expenses is there. There is the brokerage. How much is the brokerage? 2% of the transaction value. How much is 2% of 2 lakh? 4,000. How much is 2% of 20,000? 400. How much is 2% of 2 lakh 20? 4,400. Now can you tell me the NSC, net sale consideration? 1 lakh 96,000 in case 1. 19,600 in case 2. 2 lakh 15,600 in case 3. We will think about cost of acquisition. When it comes to the cost of acquisition, they are using the word cost 30. Cost means all the cost. Are you with me? Doesn't matter. Doesn't matter because it is purchased in 1990. It is purchased in 1996. So you have to always go for the fair market value as on 1st April 2001. So there is no problem, but only for the sake of saying I said it. Okay. So 80 per share into how many original shares? 1000 into index number 348 divided by 100. Can you help me with the math? 2,78,400. That will end up in loss. How much is the loss? 82,400 is the loss in case 1. Long-term capital loss. Second case, what is the cost of acquisition of bonus shares? 2 minutes. What is the what is the cost of acquisition of bonus shares? Fair market value as on 1st April 2001. Why? Because August 2000 is before 1st April 2001. Doubt, go check the calendar. You don't have to check the calendar, okay? August 2000 is before 1st April 2001. This is the problem of evening. Okay, for understanding this, you have to check the calendar. Don't check the calendar. It is 2000 August. That is before 1st April 2001. So what to do? Fair market value you can take. So 80 into 100 share into 348 divided by 100. 27,840 will be the indexed cost of acquisition. And for the third asset, nil. Why nil? Why nil? After 1st April 2001, there is no cost of acquisition. So second case loss will be 8,240. Third case profit will be 2,15,600. This is long-term capital gain and the others are long-term capital loss. Now my question is, can you adjust long-term capital loss with the long-term capital gain? Yes, you can adjust long-term capital loss only with long-term capital gain. Are you with me? Yes, set off and carry forward. You cannot adjust long-term capital loss with short-term capital gain. You cannot adjust long-term capital gain with, long-term capital loss with short-term capital gain. Not possible. But this is long-term capital gain, so you can adjust. Can you net off and tell me? What is the net long-term capital gain? 960. 60. 960. This is the final answer. Yes. So please take a note of this answer. And that's all for today. Okay. I have no plans to extend. Tomorrow we will be starting with the capital gain, IFRS, 115 BAC and computation of total income. That is 115 BAC. Okay. And I'll be leaving around 5:30. Okay, in between 5 to 5:30. So that's all for today. Take care. See you tomorrow and bye-bye. Sir, how to make difference of brokerage? The word cost, that is the impact, Maunika. It is the word cost. Cost means all the expenses. Okay. Sales value, they say transfer value. Transfer value means your sales value. From that, you have to deduct the direct expenses. Yes. Okay, see you tomorrow. Take care and bye bye, friends.